here, some may say that crypto sold tokenization as the bridge to Wall Street. The breakthrough in the evolution of the space is putting yield to work. Now, stablecoins are the bridge making this happen, connecting traditional bank rates with crypto returns. Well, joining me this morning to talk about scaling institutional grade infrastructure, as well as to talk about risk management and compliance, is Nick Cannon, Chief Business Officer at Gauntlet. Nick, good morning. Thank you so much for joining me. Well, large allocators want yield as well as capital efficiency. So for the layperson out there who is watching right now, they're wondering why DeFi yields are so critical right now and what this does to shift from tokenization to yield markets. What does all of this look like and where are we going?
It's critical right now because the cost of capital is cheap. You can borrow billions of dollars on chain below SOFR rates right now, and that's particularly appealing to anybody tokenizing real world assets or private credit or a variety of other things that are starting to come on chain. There's global demand for these things, and blockchain rails really help that.
Yeah, and Nick, let's look at the fiat side of stablecoins. So the cash engine is the off-chain net interest margin and the yield issuers make on assets like treasuries. So how important is this off-chain NIM and how does it act as the baseline for everything else?
For existing users today, and the few hundred billion of stable coins right now, and a lot of the billion and a half we manage in our vaults, it's actually not that important. Access and the use of the stable coins and the initial adoption was traders and market makers and people using payments and remittances. So while it might be helpful for stablecoin issuers to have a very viable business model, and of course like regulation is still outstanding of what that looks like as far as yield or indirect yield. There's demand separate the U.S. Regardless. So that's not necessarily driving it. You have a lot of credit and other like products on chain, and those are just up and to the right, despite macro, despite Bitcoin and Ethereum prices being down. The stablecoin yield and demand for a variety of these use cases and liquidity on chain is just growing.
Yeah, and building on what you just said, can you walk us through some of the emerging hybrid market structures and explain to us how they actually bridge regulated yield, the traditional yield, with permissionless DeFi liquidity?
Yeah, Gauntlet's been around 8 years, and we started with a bunch of quants coming from high frequency trading, D, Shaw, and Jump, and GetGo, and we saw a lot of opportunity for models and simulations on chain. But in the past few years, as the market's matured and we've moved from these global multi-collateral, multi-supply side pools of credit, vaults have very much emerged, and we moved from kind of the mid desk, you could say, to front office a little bit more. And the biggest markets right now are in the low tens of billions is standard credit markets. Borrow on one side, historically, primarily Bitcoin native assets and increasingly tokenized assets. And then on the supply side, on the lending side, is primarily stable coins. And that matching engine is 24/7, 365. We're on 10 chains ourselves and 6 different types of credit protocols. And just despite the drawback is still very much growing, and we see healthy demand.
Yeah, and speaking of which, if you look at the big picture, if you take a step back and if we combine these yield markets with programmable privacy as well as compliance, what do you think the next couple of years actually look like?
Yeah, right now, the biggest concern and maybe a lot of the hesitations for the institutions is, this is permissionless. Who are my counterparties? Who are the actors in the space? I don't know who the users are. I want to make sure, legal and compliance are, of course, on the same page. But with this modularity coming on chain, we can now permission and programmatically do so for not just KYC, but every other covenant that you would in an off-chain agreement, an LPA or something like that. With cryptography, it's sound, it's verifiable by regulators, it's verifiable by your back office, and that's very much where it's going. You'll see hybrid models, you'll see fully permissioned models, but the TAM of this is absolutely exponential.
Yeah, and finally, before I let you go, I want to ask you how all of this shifts the trajectory of stablecoins from just crypto adoption to more capital markets migration. And I do want to also ask you about the role of regulation here in the US.
Yeah, stablecoins very much are. It's driving a lot of things. It's powering a lot of the back ends of, as I mentioned, remittances and payments, and now we're powered by and in the backside of a lot of centralized exchanges and fintechs. Where does regulation go? We're actually relatively indifferent ourselves. We think there's a demand on the edge, and that long tail is quite long when you think about the globe. The goal for us is very much not to worry so much about getting assets on blockchains. The goal is very much to build a risk engine in a market that creates more liquidity and opportunity better than a human at a desk in Midtown ever could.
Okay, Nick, well, thank you so much for joining us on this Friday morning. We appreciate your time and thank you so much for joining us.
Thank you.